Welcome to the Market Huddle with Patrick the Content Machine Ceresna and Kevin the Macro Tourist Muir. So grab a drink, get comfortable, and get ready for a deep dive into the markets. Take it away, guys.
It's November 26, 2019, episode 56. I'm Patrick Ceresna.
And I'm Kevin Muir. This is a special U.S. Thanksgiving Market Huddle, and we are taping it early on Tuesday afternoon. This week, we are joined by Victor Adair from Polar Futures Group, and then it's time for Kuppy's Corner, where Harris updates us on his new retail play.
Then the rest of the show will be viewers sent in question and answers. Lena, who is the show brought to us this week by?
This week, the show is brought to us by Lock Street Brewing Company's Jealous Mistress English Brown Ale with Honey.
English Brown Ale. All right.
Jealous Mistress.
That's right.
The most dangerous beer out there.
So it's supposed to have medium-bodied with caramel, cola, and meat flavors.
Oh, wow. First of all, it's 6.7%. It's a great way to start the Thanksgiving week. Wow. What is that? It's like
I don't know. Let's just. My mother taught me when you can't say anything good, you just don't say anything at all. Let's go on.
We'll save it for after the show's done.
Whoa. I think Patrick likes it, though. Okay.
All right, so put your disclaimer out here.
Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much huddle may include breakout euphoria, paralyzing, petrified currency pneumonia, and or Brazilian real or real spine nausea.
All right. Well, let's get on to the show. So joining us now is Victor Adair from PI Financial, who is the derivatives portfolio manager over there. How you doing, Victor?
I'm doing great. Thank you, Kev.
Oh, that was Patrick, but that's all right.
It's okay. You know what, Victor? A lot of people can say they can't tell the difference between us.
No,
all right.
It's all good. But listen, we wanted to get you on because we wanted to pick your brain as to what's going on here in the markets. I mean, one of the things that you were highlighting was this key turn point that occurred back in September. I think it's a great place to start this conversation. So what did you exactly see and what's on your mind?
Well, a number of markets turned right on or about the 3rd of September. I mean, the key one that got my attention at first was the bond market. I mean, that was the day that the U.S. long bond traded at its lowest ever yield, and then yields started to rise from there. But the thing that made it just that much more interesting, and I noticed this like a couple of weeks after the fact, was that a whole bunch of other markets also reversed right on about that same date. And when a whole bunch of markets move at the same time, it kind of makes it just that much more significant. In other words, the inflection point to me becomes that much more powerful. Now,
right.
I mean, and then as time has gone by, I've seen a few other things. I thought, gee, I missed that. For instance, the British pound had a multi-year low right on the 3rd of September, and it turned. The German long bond was turning right about that same time. And I wondered, what was the center of this turn? If it was like the British pound, it was maybe the easing of Brexit worries. And then, as you trade as well, when things are moving in the market, like you drop the pebble in the pond, it ripples out. So like everything gets affected to some degree. So on my website for the past month or so, I write these weekly notes. And I've just been going on and on about the key turn date. And I guess the real big thing here is I'm saying it might be the polar opposite of 1981 when interest rates were, really, really high. Remember at that time, Canada came with a 15% yielding government bond. You couldn't give it away. People thought inflation was going to go on forever and so on and so on. So now people, are so desperate to own bonds, they're willing to buy bonds that are deeply negative. So maybe it's the polar opposite, and
Victor,
why that's important. Yeah.
You know what? You got to see the smile on Kevin's face because this is like music to his ears, and
I knew there was a reason we got Victor on.
for sure.
Okay.
Victor, I couldn't agree with you more. And it's interesting that you noticed the date that all these things turned, and you mentioned a few different kind of potential, let's say, asset classes or securities that might have led it. I'm actually of the belief that it was the German Bund that led the move upward on all these yields. Yeah. Oh, so you're the same belief. Why do you think that?
Well, because it was the let's say it was the Europeans and the Japanese that created all these negative yields. I mean, really, nothing else matters if you take them out of the equation. And like the epicenter of it was, I thought, the German bond, and it just got to that point where it wasn't going to go any lower. They started talking about maybe instead of driving negative rates deeper and deeper and deeper, the ECB, I mean, that maybe it was time to pass the baton over to the governments to do fiscal stimulus. What a great time to issue bonds when you get paid to issue them. And that sort of thing. So, but here's another barometer. Both the euro yen and the euro Swiss turned on that same day, with the euro rising relative to those other currencies. I mean, the euro Swiss is kind of the barometer of, call it the fear and trembling in the European market. Swiss gets bid when everybody's worried, and on the euro it suffers. And I think the same thing with the euro yen spread. So a lot of things happen on that date. If it is the polar opposite, what's important to me as a trader is that all kinds of positions have been built on interest rates are going to stay low. And if interest rates don't stay low, then those trades are mispriced, right? And I want to get in front of people correcting that mispricing.
And so you think it's a secular change that is as important as those early days in 81 when the long bond topped out at 15%? Like you're thinking that summer rally in bonds, the interest rate bid that just seemed to be without end all summer long, that was the kind of the buying climax? Is that what you're going assumption?
Exactly. When I look at, I even posted a chart where I just showed, let's say, July and August. In August, the bond market was just gapping higher. It looked like, the juniors are on the desk, the senior guys are away for summer vacation, and people are just throwing in the towel. The bond market just raced away to the upside, and there you go. Now, in terms of, is this the secular turn? I'm just saying, it might be. As a trader, I want to try to imagine if the world is different than what it is now. And, this is one idea. Now, if the bond market continues to rally, I'm not going to stand in there like a dummy, with a short position and say, I know I'm right and the market's wrong. I'll be out. But, this is, if I can find something like this and then it starts to put some meat on the bone, then I'll run with the trade.
Okay, so what are you looking for on those meat on the bones? Like, what are the type of confirmation that you're looking for, and what are the best ways to position for that going forward?
Oh, I'm so glad you asked me that question. I mean, the last couple of months, I've been shorting Treasury notes on and off. And by on and off, I mean, I'll take a position, it goes my way, I'll take it off, market will back up, I'll put it back on again. But the other trade, and this is like the derivative that's really got me interesting, is gold. The gold market ran up about $350 from November of last year to the key turn day on September. It turned the same day. And I think gold during that period of time wasn't paying as much attention. It wasn't being affected as much by the U.S. dollar, which is usually the flip side of the gold market. But I was paying attention to real rates. Real rates just kept falling. And as they kept falling, the gold market kept rising. As the gold market kept rising, more and more and more people kept buying it. And I think as much as the people out there that are gold bugs, a lot of them hate what they call the paper gold market. That's COMEX. COMEX sets the price. There's just enormous leverage that people can use there. And that is like the center of the universe for setting the price of gold on a short-term basis. So I've got this huge open interest in gold relative to what it's been, huge bullish positioning by the speculators. So if the price of gold starts to roll over, as it has, is off about $100, and I see now that open interest this past couple of days is starting to fall off some. Gold may be a great short, and by that I'm not saying it's going to go to zero, but I mean if gold falls off $50 or something, I mean that's a real worthwhile trade for me.
Yeah, so you basically think this backup in real yields hasn't been completely reflected in the gold market yet. It hasn't corrected enough based upon the move in the bonds. Is that kind of the line of your thinking?
Yeah, and I think maybe something I like to do is I try to find a market that's unbalanced. And I think but just come back to gold then, there's been this massive embracing of the bullish thinking on gold, and people are in there in the futures markets. And as the market has run up over the course of 10 months or so, and they've been, they're right. And when you're right and the market's going up and you add and you're using more leverage. So, but at some point, if the market starts to back up, those guys turn sellers. And if they turn sellers, it accelerates the downturn. So I don't think we've seen the selling yet in gold, and maybe it'll never come. I mean, I could easily embrace the argument that, some point out in the future from now, gold's a lot higher because the world goes crazy. So maybe those guys have got their eye on a longer term time frame than me.
So Victor, on the screen there, I have the shot of the long bond with gold overlaid on it. And the correlations have been very evident, hence what you were talking about there. So in general, the takeaway I would have here is that you think bonds will continue to weaken, and then gold will more or less stay within this correlation and continue to weaken with it on this cycle. Now, what I wanted to ask you, first of all, is that correct? Am I assuming right what you're sharing with us?
Yeah, that would be the thesis, and if it doesn't happen, it doesn't happen, and I'm not going to lose a fortune if it doesn't happen. The bond market. Go ahead.
No, the question I have for you is all about time frames, right? Like, so now a backing up of gold of, let's say, $50 to the downside, and treasury bonds taking one more dive lower can be even a short to intermediate time frame move, right? But at the same time, the idea that we've saw this massive turn in September 3rd, that's a real big picture call, that's a multi-decade call, even arguably. Sure. And so I'm trying to sort of match together what your sort of roadmap is for the most intermediate term. Like if we do see the further weakness, which is on both of these markets, do you think we're going to see some short-term lows? Like how do you think the long bond reacts if we, let's say, have the Fed, for whatever reason, continue cutting, right? I mean, everyone's still on the fence as to whether or not this was a mid-cycle adjustment or whether we're in a new cycle of Fed cuts as they're going to go down to zero. Whether that happens or not, as the long bond goes, as the short bonds go, do you still think the long bond is where that they just won't participate, that the long bonds peak is in irrespective of what the short interest rates do?
It could be if in fact the long bond is going to say switch from we're in a recessionary environment. That was kind of the thinking I think that was going on this summer that really helped take prices way up, helped drive the total of negative yielding debt to the $17 trillion threshold. And that seems the past couple of months that thinking about where the narrative that we're falling into a recession seems to have quieted down. I don't know. I'm not going to pretend I'm an economist. I know I don't know what's going to happen in the future. I'm just thinking in terms of possibilities here, seeing that correlation. And I think with the gold, there's one more thing that's coming in. I did say when the gold was having that long run up from November of last year to the September high, it was not much focused on the dollar. It was much more focused on rates. It's been my experience over time that just as you figure out a relationship between a couple of markets, the relationship changes. So maybe the gold market doesn't stay tied too much to the bond market, although I think it will. But maybe if the dollar gets some strength, or let's say the other currencies weaken, And just a very quick segue there. There's a thing I'm calling the stealth strength of the U.S. dollar. We watch the U.S. dollar index. It's what the composition of that is. The stealth strength I'm talking about is kind of like the off-the-run currencies, the emerging market currencies. For instance, we had the Brazilian real drop to a new multi-year low today.
Right.
I'm short the Mexican peso as a possible contagion play on what I see happening in the South American currency markets and economies and so on. So maybe the U.S. dollar strengthens, and that puts gets the gold market knocked down a bit. What I'm focusing on with the gold in particular is just this perceived vulnerability that there's a lot of people long, and a lot of them are already underwater, where you see where the open interest has been added the past few months. And if the gold market, for any reason, was to go a little lower, we might get those guys thrown in the towel, and that would accelerate the move.
So, Victor, Kev here. So we have the bonds backing up, which means the possibility the gold might get weak. What are some other trades that you're looking at as a kind of a consequence of that September 3rd kind of turn in markets that you saw?
Well, I wish I knew why the markets turned on that date. We talked moments ago that, maybe the epicenter was the German Bund, and I could see that because of the changing in the guard at the ECB with Lagarde coming in. I'm trading other markets. I've had some positions in the WTI market. The Canadian dollar, I've been shorting Canadian dollar. There, I think Canada is more likely to be cutting interest rates than the U.S. Wild card there perhaps is the USMCA, as they refer to it, the new NAFTA. And as I was saying to Patrick before we got started here, from time to time here in the past month or so, I've taken some short positions in the stock market. Most of them have turned out to be losers. So,
So
one of the things that I was saying to my son. Yeah.
Sorry, I agree with your Canadian dollar weakness call, so you should be warned by that. But,
oh dear!
When we all agree on this show, it tends to work out on the contrary. But you did mention crude, right? What's your thinking on oil here?
What I've noticed is a lot of times crude, the WTI, and let's just say the WTI and SPOOs turn on about the same date. Like they turned at the same time in October of 18, both went down. They turned at the bottom in December, went up. And there was a couple of other turns, this spring. I'm forgetting without looking at the chart. But I did notice that actually from about 6 weeks ago, we've had a bigger percentage gain to the upside with WTI than we've had with the stock market. And in that sense, the stock market has outperformed. But if I could just finish one point on the stock market, I remember saying to my son, Drew, who works with me, it's got to be 4 weeks ago anyway. I said, if this stock market makes new all-time highs, there's a lot of people that are going to have to buy this market. I think there's a lot of money managers out there who are cautious about the market right now. They got maybe more cash than they might have otherwise, cautious for good reasons. But given that, there's way more money in the market that is managed by people managing other people's money than what individual traders are doing, and those managers have got to keep up with the Joneses, or they're going to lose assets.
Career
and I think
risk.
that really Sorry.
Yeah, I was just saying it's career risk for those managers, and if they're underweight, then they're underperforming, and they have to chase, right?
Yeah, exactly.
So, do you think crude oil is heading higher? Are we going north of 60? What's your intuition here?
I don't know. When I look at markets, I imagine possibilities. I mean, we had that spike right on the attacks on the Saudi facilities. The market came back. We've made some lows. What was it, around the $52 level? We've made that 2 or 3 times here the past couple of months. I'd say, other than something that's peculiar to crude, the OPEC meeting and so on, that the crude market's more likely to follow the stock market. So, and I don't know where the stock market's going, other than I think it's pretty rich, and we're vulnerable to a setback. So, I guess not having a position, I'm comfortable with that. If I want to take a trade if I've really got an opinion, and I'll have a strong opinion, or as Dennis Gartman used to say, a strong opinion, but just weakly held.
Well, Victor, it's Kev here. I love your letter, and I love the fact that you are a true trader at heart. That is one of the things that kind of strikes me the most about your analysis, is that you're not tied to something. You're not sitting there saying, I know which way the market's going. You're just dealing in probabilities, and it's a terrific kind of mind frame to have in terms of setting up trades. Why don't you leave us with just one more kind of setup or an idea that you might be having for the next week or two, or maybe a little bit longer, whatever it is. Just one last idea for kind of listeners to get an idea of the kind of trades you like to do.
Yeah. Well, I guess I've talked enough about gold, and at the very moment, I don't have gold on. I started today with a short position, didn't like the look of it, traded out of it. One of the things I think is you got to keep the time frame of your analysis in sync with the time frame of your trading. So, I mean, that'll wiggle around from time to time, but sometimes I'm looking at something and say, I don't like the way that feels. So, okay, just bash it out, get rid of it, just go to the sideline, and then, maybe you get more clear thinking. If you're hanging on to something, waiting for it to inevitably turn in your favor, that almost always goes bad. So I'm curious about what will happen with the U.S. dollar. The trade, I guess, that I have on that I'm really interested in right now is this short Mexico. Again, there's been a big buildup of bullish positions in the Mexican peso over the past couple of months. If the peso was to start, the pull of gravity from worries so they're in recession, maybe the country is ripe for some contagion coming up from South America, I think the Mexican peso could take a little tumble here. So that's something I'm watching.
That's a great trade to leave us with. So, Victor, for those who want to learn more about what you do, and I highly recommend that everyone subscribe to Victor's weekly notes. It's something that I get on my inbox and look forward to every weekend. Where can people find it and sign up for your weekly kind of what is it, a newsletter? What would you call it?
Yeah, what I call it my trading desk notes. I do a radio show out here in Western Canada with my good friend Michael Campbell. We've been doing this for years and years and years. My website is polarfuturesgroup.com. Everything on there is free access. I write my trading desk notes usually on a Friday, post them Friday evening, and then I use them for the dialogue, the Q&A that I have with Mike every Saturday morning on the Money Talks radio show. So polarfuturesgroup.com.
Great. Well, thanks a lot. Thanks for being with us today, Victor.
Hey, it's been great, guys. Super.
And for everyone, please stick around. Victor's going to be joining us in the after hours to continue his conversation.
Okay, it's that time of month again. It's the last week of the month, and it's our pleasure to have Harris Kupperman for Kuppy Corner back. Harris, great to have you with us.
Hey, thanks for having me on, guys.
So listen, I got this email from my old man, and he says something like, Harris has done it again. And I was like, what is he talking about? And then he said, with his retail play. And I take it that you nailed another trade. So why don't you tell us about it? Tell us the whole story and if it's still a buy up here.
So I'm not sure if I've nailed a trade yet. I'm up 30% this week, but look, I bought it Tuesday. It's not a victory yet.
It's funny. Actually, I just Harris, one question for you. Do you think that you're actually moving it? Do you think that big update was you, or was it just?
Of course it is. Harris has that much influence on the market.
It's the Kuppy effect. It's the
Kuppy effect for sure.
Yes. 2/3 the shares outstanding traded in the last 4 days, and it's all my fault.
Okay, why don't you give us the story, Harris?
Okay, so company's called Stage Stores. Ticker symbol is SSI. It's been around forever. They had the brilliant strategy to roll up a bunch of dying department stores. If anyone hasn't paid attention, department stores are comping like -10 every year. They figured they'd put a bunch of them together and hope to make it up in volume. They were basically just bleeding to death. It's one of these stocks that like every 6 months, one of my friends is like, but there's a lot of asset value left, and you just see the asset value kind of leak away, and you're just like, nope, not anymore. Uh, but look, I've watched this thing melt away from like $20 to less than $1, and so anyway, they 2 years ago, they bought Gordman's, which was yet another department store chain. They bought it out of bankruptcy. And Gordman's, somewhere deep in the bowels of Gordman's, they had this off-price retail business. Off-price being like TJ Maxx, Ross Stores, Burlington. And if you look at any of the charts of these things, they're just up and to the right. Consistently, they just keep going. And it's just a great business. You're on trend. Millennials love bargains. I mean, I love bargains. And so it's just been a great business. And these guys looked at this Gordman's and they said, hey, we could do this. And they started converting some of their shittier department stores in cities with no people into Gordman's. And the amazing thing happened is they started comping positive. And so they started doing more of it. And in 2019, they converted 89 stores. And they had an astronomical 40 positive comp, which just doesn't happen in retail. Admittedly, that means that instead of 5 people that month, it's 7 people. But it's, I mean, who the hell shops at these things? They're like worse than a JCPenney. Do you know anyone who's been to a Beals? Bells? I don't even know how to pronounce the thing. But they have 800 of these stores, and so they've been converting these things. And all year long, they've been announcing that comps are getting better, but everyone ignored it because it's a small little piece of the business. And so anyway, on Wednesday, they announced that they're going to convert all of their stores, all their remaining stores this year to this Gordman's, which is a terrible brand name, but to this Gordman's off price because they did positive 40 comps. And as I said, positive 40 comps doesn't happen in retail. Up teens is life's changing and that your stock doubles. And so here you have this plus 40, and no one really knows what's going to happen, but it seems like the ones they've already done are going great. And I don't think it's a great investment. I think it's actually probably a terrible investment. But I think it's one of these. But I think it's one of these things where people want to believe. I mean, everyone's had a bad year in the land of value. There's a lot of value still here. People want to believe that you can do plus 40 comps next year on all the conversions. And I tend to think that you probably don't get 40s, but you probably get teens. Maybe you get a little better. I mean, remember, you're coming from a super low base in terms of sales per foot. And I just think this is an up and to the right until they bungle it all this time next year. But you probably have 2 or 3 quarters where, the earnings won't be good. No one will care. There'll be one-time charges. No one will care. As long as the comps are good, and the comps have been good, it's just going to trade up. And look, it's 125 million market cap today. I bought it at about an 85 million market cap. I mean, if you compare this to their peers, which are trading at like 2-3 times sales, and these guys are less than 0.1 times sales, there's a lot of gap to close. I mean, if these guys get to 0.3, 0.4 times sales, you have a multi-bagger from here. And if they actually do something like a reasonable gross margin, I mean, I could build a model that says these guys make a few dollars a share and it's only trading at $5. I mean, I don't think that's actually what happens, but I think guys will make that model and it's going to trade up to the right. So I wrote about it when it was at 3.5, and here we are at 5.
Do you have any opinions on the other retailers? Because, I mean, we saw Bed Bath & Beyond have a big turn up. You saw everything from Best Buy, Tailored Brands seems to be putting in a bottom. Like, a lot of these retailers were just destroyed. I mean, Macy's is still down at the bottom end of its range. But do you think that these things were just like the baby's been thrown out with the bathwater on all of these, and there's huge room for mean reversion in value on the retail space?
No.
I love the honesty. Perfect. No.
I mean, I guess the joke. Take Bed Bath, okay? About once a week, one of my friends is like, "It's so cheap." I'm like, "Yeah, you've been telling me that since we were at 60," and and we got to 10, then we got to single digits, and I guess the joke was always when Bed Bath goes bankrupt, where's my wife going to waste my money? I mean, I literally come home on like a Sunday, and there's like 9 bags of this shit. And I'm like, you spent $500 at Bed Bath? But I guess people still shop there. I don't know why. We have like new blenders and new knives and forks and whatever it is once a week. But No, I just don't understand why these exist. Like, one, you have terrible competitive issues because you have a bunch of guys like Wayfair. Like, just look at like Bed Bath versus Wayfair. Wayfair has been as clear as possible. They intend to lose more money each year and hope to basically bankrupt Bed Bath. Like, how do you compete with that? It's impossible. They're just going to keep gaining market share. Um, I don't know. Tailored brands. Look, I think the tuxedo business they have is a true competitive moat business. Um, I've been to enough of these weddings where you're all supposed to have the same exact Calvin Klein tuxedo because you're all in the wedding party, and we're all coming from different states. And the only place that you could go that has a location in every state is Tailored Brands. So yes, they have a moat, but when was the last time you wore a suit? Like,
I happen to wear a couple every once in a while. But
So Harris, you and I were, it's Kevin here. We were chatting yesterday, and I noticed a certain new spring in your step, and kind of a rejuvenated Harris is back in the game. And what do you attribute this to?
oh, vacation. Got to take a. I took 3 weeks off in the Caribbean. I feel great. My brain feels great. Look, I had a pretty shitty Q3. Look, the global economy ain't so pretty, and I've been short, and market just keeps going to new highs, and it was an expensive opinion, and so I just said to hell with it. Cleared out my book. I literally went down to like 5 positions, like my core book, and went on vacation for 3 weeks. And the great thing about going on vacation, especially somewhere like the Caribbean where the internet doesn't work too well, is you're not tempted to take out your laptop and log in and try to do something stupid. You just totally clear your head.
So Harris, after this, I'd like you to get on the phone with Mrs. Macrotourist and suggest that that's what I need on a more regular basis.
Absolutely. Before I started my hedge fund in January this year. I pretty much every 6 months took a month off. And I went there, and my wife and I, we'd go rent a, car, and we just start driving around, whatever the country is. And, you kind of check in, but unless it's earnings season, the odds that something's going to happen in one of my positions is minimal. And if it does, someone will call me. So it's just great to get away. And then I started my hedge fund, and I forgot that tradition. And, when you get 10 months into the year and you haven't had a bit of time off, you forget that you can actually step away, and, the portfolio is still there. And but I've come back and I've said, yeah, so they're going to print a bunch of money. The market's probably going to go up, and the economy's going to collapse, and we might just pull a Zimbabwe. And you can't short the market.
I've definitely noticed that kind of a definite new Harris. So I think that we should encourage everyone to take 3 months off in the Caribbean whenever you're feeling a little down.
3 months, 3 weeks.
Or sorry, 3 weeks. I'm turning. I'm trying to up it. I figured 3 weeks isn't quite enough. 3 months is what you need. So why don't you give us an update on some of your other names that I know you wanted to remind everyone that you're no longer in the Greek ETF. Why don't you just kind of touch base with that?
Yeah, sure. Look, the trade worked. It worked well. It's up 20% from where I put it on, and it just felt like it was stalling out. As I said, the global economy ain't so good, and most of the Greek economy still is people going to see the Parthenon. And so, when you're I didn't even mean that to be funny. I meant that to be factual.
That's even funnier.
But so you got, there's just less people who have disposable income to go tourist. And the economy's not going as fast as I thought it would be. And I just said, okay, I have a victory, move on. And when you're doing trend investing, which is a lot of what I do, some of these trends do better than you expect. Some do worse. And a lot of them are kind of baseline. I'd say, the Greek trend was kind of like a 4 out of 10. It didn't quite do what I thought it would do, but it didn't exactly fail. And I figured I'd just mention it that I'm out, and I don't want anyone to
I'll take the other side of
Kuppy.
that trade. I think Kuppy is headed higher. I think you're not being patient enough, but that's what makes a market. Why don't you tell us about the one you are excited about, which is our tanker stocks?
Yeah, absolutely. I was going to say, sometimes they don't go as well as you expect, and sometimes they go a lot better. And all year long, the story at Scorpio, or pretty much all tanker stocks, just keeps getting better and better. The newest thing is, we haven't even finished IMO 2020, and we're already thinking IMO 2030. IMO 2030 is this sort of nebulous set of regulations that everyone knows is coming, but no one knows what it actually says, which is probably going to make any vessel you order today obsolete by 2030. And so if you're ordering a vessel and you expect to have it on the oceans for 20 to 25 years, and year 6, 7, or 8, it's obsolete. Like, are you going to order something today? And so if you look at all bull markets in shipping, they always end when people start making money and they grow their fleets. So guys might not grow their fleets this cycle, or maybe not grow as fast as previous cycles, because no one wants to be the guy who orders, the last model of a diesel propulsion ship and learns that it's obsolete next year. So it just keeps getting better.
Elon Musk is going to give us all battery kind of ships by then, I'm sure.
Well, I think that's what a lot of these regulations are looking towards. It's probably going to be hydrogen. It might be LNG. It might be methane. I mean, there's a lot of propulsion systems you can use that produce less carbon dioxide. The problem is, if no one knows what the rules are, no one's going to order anything.
So it'll actually be a bigger bull market because of that fact. Because of the uncertainty that'll stop the supply response that we'll get with the higher prices. They won't come. I guess to combine that with the fact that everyone still probably doesn't believe. And although there are some people that are waking up to these tanker stocks, let's face it, in the grand picture, they barely moved.
Right. I mean, look, in the last month, the short interest in Scorpio has doubled. I mean, who the hell is shorting a stock where management's telling you they're going to earn $25 this year and the stock is at 34? Like, I just don't get it.
Wow.
People just don't believe it. Well, look, they've been lied to a lot. It's actually, I was joking with So, I mean, I used some of the proceeds from my Greek ETF to go buy some more tanker stocks. And some of my friends just kind of said that I shifted one set of Greeks for a different set of Greeks.
That actually probably is right. But so are there other the Greek stocks, other shipping stocks that you're watching there?
Yeah, there's a bunch. I mean, LPG is doing great. If you want to really go out of the spectrum on the risk side, there's a company called Navios where, they're kind of guiding. It's an $8 stock. They're kind of guiding that they're going to earn something like 40 or 50 this year. I mean, if they don't, they're not going to roll their debt next year. So it's sort of binary, but I mean, it could be 0, it could be 100 this time next year. Like, you just don't really know. But you have this sort of operating leverage where if you look at tanker rates, pretty much every day they're going higher. I mean, we're at 10-year highs and they're not pulling back. They're just going to keep going. A buddy of mine who works at a large trading house in Singapore reached out to me today, and he said kind of like we'd been questioning this for a while. And he's like, Kuppy, it's actually happening. What's happening? Well, all this high sulfur fuel that the refineries produce, they have no idea what to do with it, which is sort of something we'd speculated, but we didn't really know. He's like, they just ordered an Aframax. They're going to store it on the Aframax. So that's one vessel. Who cares? But if you have a refinery, you produce this low sulfur stuff, this high sulfur stuff that no one right now needs because everyone's going to burn low sulfur starting in January. Well, where's this stuff going to go? Well, you're going to use up your land storage. And then what do you do with it? Well, you're going to have to start taking tankers out of the market and your floating storage. So you have a bunch of tankers that should be earning a lot of money crisscrossing the oceans. They're going to be sitting there storing fuel, like pretty much waste fuel that no one can burn unless you have a scrubber, which is only a small piece of the fleet. So you're going to see the global fleet that's available to trade potentially shrink dramatically at a time when demand is growing fast. So it just keeps getting better and better.
You think people will go and be faced with like a storage constraint and use these ships as their floating storage?
Okay, so you have a refinery. No one needs high sulfur fuel today, okay? Because there's not a lot of scrubbers. Well, when you refine crude oil, your waste product is high sulfur fuel. It's just you could re-refine it, but it's very expensive, and you're just going to end up with high sulfur fuel when you re-refine it. So what do you do with this stuff? Like guys in Nigeria, they burn it for electricity or something, but there's only so many power plants in the world that can burn this stuff. I mean, you have above ground tanks. You use your above ground tanks, and it has to go somewhere. You can't just dump it in the ocean, and it's going into Aframax apparently.
Wow. I don't think Al Gore is going to be very happy about that if we started burning it. By the way. Okay, so we got that. Now let's go on to the other one, which is the uranium stocks. What are you thinking there? Are we ever going to get a rally? And is this like waiting for Godot?
It's a waiting game. Look, I don't own any uranium stocks. I own uranium participation. That's the only one to own because it's physical uranium. All these other stocks, you have to remember that the vast majority of them aren't producers. So if you're not producing and you have no revenue, you basically have kind of a scumbag sitting there spending your money on investor relations or his personal travel or.
For those uranium mining companies that want to reach Harris, it's H Kuppy at Twitter.
Yeah.
Go on,
But-
sorry. So uranium participation is the only thing just because we're below the cost of production, and why buy a mine with all sorts of risk when you can buy the actual fundamental underlying commodity at less than the cost of production? Is that basically the thought process?
Right. I mean, well, look, there's a couple sets of these. You have the guys that don't have a mine, never will have a mine. They just own some pasture somewhere, and they're just selling you a dream. Look, there's enough shuttered mines out there in the world today that when the price of uranium goes up, these mines will come back online because it's easier to flip a switch. Well, it's not even that simple, but to turn your existing mine on than to build a brand new mine. And when all the existing mines come online, all the prospective new greenfield mines will never come online. So what you have effectively is some pasture in Alberta. You don't have a mine. So stop thinking you have a mine. Stop emailing me and telling me how cheap it is on a market cap to pounds in the ground, because those pounds will be in the ground when I die. It's like a logical.
Hopefully, it's not.
reference
Hopefully,
point.
it's not at the hands of a disgruntled uranium mining executive, Harris. So now, what do you think on uranium participation? Like, do you think that like you own this? Is it a large position for you? Like, you don't need to tell us exactly, but is it something that you use as a buffer for the volatility in your portfolio? And do you expect this to be a double over the next year, or like what is your kind of your sizing and your kind of risk reward of where you think it heads from here?
So it's a medium-sized position. I have a rule. I don't do anything for less than 5%. I just found if you take small positions, you don't watch them closely, you're pretty much guaranteed to screw them up. I mean, my average position size is about 10%. I'm usually a 6 to 12 name fund. So I'm playing big. So this is about an average size position. Look, uranium's trading at 25 right now. Uranium participation trades a few ticks below NAV. I think uranium's probably 50 at some point in the next 2 to 3 years. I just don't know when. And maybe it overshoots when we get to 75. So I think it's a pretty low risk double to triple. And you don't get a lot of those where you're pretty much guaranteed that in the next few years you will double or triple your money with almost no possible risk to yourself, because, look, it's going to cost me a penny a quarter to hold on to this thing. That's the carrying cost. It's marginable, so it's not tying up my balance sheet. And, look, I don't think uranium goes below 20 again. And if it does, I'll just buy more. So there's no risk of permanent loss. It's just kind of mark-to-market loss. Like, why wouldn't you have a lot of this? And my thinking is I started it at a certain weighting. I'm going to add 50 bips every month. I'm going to average in. I'm there at dime below the market at all times, and I'm just going to keep averaging in, and I'll get it to a full position if it doesn't turn in 2 years. I'm just going to keep averaging in because I know I'm 1 month closer to the date where the above ground stocks get used.
Sounds great. So Harris, listen, we're taping this on Tuesday afternoon. It's going to air on Saturday, but it's just you are an American, so I wanted to first of all wish you a happy Thanksgiving and wonder what your plans are. You got anything exciting going on?
My wife's taking us to go do Thanksgiving with her family, so that's all I know. I've not been told where, how, when. At some point, probably Thursday afternoon, she'll get grumpy and want to know why I'm not wearing my suit, and I don't wear suits.
And so I know, what is do you watch football? Are you a football fan?
No, not at all. Not at all.
No, you're not a football fan. So it's just turkey and Thanksgiving and in the yet to be determined location.
Pretty much. And then there'll probably be some binge drinking afterwards.
Well, sounds like a typical market huddle.
There you go.
Anyways, thanks a lot for being on, Harris. Have a great Thanksgiving, and we'll see
happy
you next
Thanksgiving,
month.
buddy.
Yeah, thanks a lot, guys. Talk to you next month.
All right.
Bye-bye.
Take care. Cheers, buddy. Kev, now we're going to do the Thanksgiving listener Q&A.
It's our first. It should be fun. I'm looking forward to it.
All right. So our listeners had an opportunity over the last week, whether on Twitter or by emailing us, to send us questions. And so let's jump right into it. And let's just see the first. So the question, Kev, the first one our listeners asked: how many listeners have you scared away with the pictures like these?
Now, those you mean that they are banner ad. I actually worry about that sometimes. I definitely have scared away a few. There's no doubt that some people have a look at it and they feel like it's been burned into their eyes, and they have to go ask for surgery to get it burned out of their eyes. But it's something that I enjoy. It's a lot of fun, and
You're loving torturing people, right?
And it's not going to change. That's all I'm going to say. It's not going to change.
Kevin, you're going to have to pay for my vision care.
That's right.
All right. So let's get
one second before I should tell you. These are the ones that I feel are safe enough to come and to make it to publication. Imagine the ones I have a whole database. People often ask me, like, where do you get all these pictures? I save everything. I have tens of thousands of images. Imagine the ones that I can't use.
I couldn't. I'm starting to go somewhere with my mind, but
yeah.
I'm just not going to say anything at all. All right. To a more serious question. The question was, what experiences and skills do you guys think are required before starting a fund, especially from the perspective from someone who hasn't yet graduated from university?
Okay, well, I obviously I'm no expert, but I will say this, that people think that having good market calls are all that matter for starting a fund or marketing a fund. The reality is that there's three different parts of managing money. One of them is obviously the managing the money. The other part is marketing. And then there's a whole other part of administration. And too often people underestimate how much the marketing is going to take out of their time. I have a lot of buddies who went and started hedge funds, and they say, listen, I don't even get a chance to go watch the market anymore. I'm too busy pitching all the time. And this is why it is so difficult. And it's those three skill sets that kind of combine. And it's one of the reasons that a lot of times people join forces with someone else, because to do it all on your own is difficult. Not only that, those three skill sets are very different, and it's very rare that you'll get an individual that has all three.
Right, and starting a fund in itself, like there's managing money. You could be a prop trader. There's all sorts of ways to put in there. But a fund is something where you're soliciting other people's money and undertaking the financial, the compliance and everything that is involved with independently starting to manage other people's money. There's so many hurdles, so much paperwork, so much everything. Just the way the securities commissions just are up your wazoo about every little detail. It's a whole other element, right?
And you see even big time fund managers like I think David Einhorn and what's the guy that fought with Carl Icahn that I don't like. I can never remember his name. The one that got into a big the one that got caught short that stock.
Ackman.
I think both of those guys have said, I'm returning to focusing solely on picking stocks because I'm spending too much time on the business end of it. And you have to be careful because, before you turn around, you won't be looking at stocks and you won't be doing what you truly love, and you won't be managing money. You'll be just running a business. Okay,
so one last thing, just because this was a perspective of a young guy or girl that is in school. And they're obviously love the idea of getting into that side. And so, like, when you're starting, like, if you're someone that's like 22, 25 years old in school, I mean, what path do you take to pursuing this?
Well, they have to go and get some experience at an existing fund of some sort and learn those different skills. But at the end of the day, if you don't know how to manage money, all those other skills won't matter because you won't be a fund manager.
Yeah.
So, the two other ones are something that you need to be able to do to be successful, but the one is essential, and that is the fund management. Okay, Patrick, I'm going to give you the next question. When does the market start discounting the 2020 election in earnest? What effects do you think a wealth tax, capital gains taxes, ordinary income, and the end of unrealized capital gains would have on the market? So that's kind of 2 points. Let's start with the first one. When does the market start discounting the 2020 election in earnest?
Well, I think that to one degree or another, it's already and all known information to one man or another is always being discounted. But the probabilities are always that an incumbent president has the probability of winning. At least a lot of history has that on there. And so I think that the market more or less is probably already discounting a Trump victory. So I think that it would actually be the part that is not being discounted would be if the Democrats really actually looked like they were going to take this for some way, and that's probably not being fully priced in. So I think that if Trump, if it looks like in the polls that Trump is going to be reelected, I think a lot of this has already been baked in the cake. What's your take on that?
I'm not sure, actually. I didn't expect an answer from you. I would say that even though incumbents are often elected, I would say that Trump, like in most cases, that being Trump, is a different ball of wax, and I'm not sure you're correct on that. I think that the market is looking past the risks of a Democratic kind of win going forward, and so I am also struggling with this question about when do those risks start to get priced in, and whether it is actually in the market as much as you think. I actually had a interesting kind of what was an interview between Ray Dalio and Paul Tudor Jones, and Paul Tudor Jones talked about what would happen to the market if Elizabeth Warren was elected. And he was of the opinion that it would go down, the S&P would drop 1,000 S&P points.
Yeah.
And his argument was kind of down, into. He said if you risk adjust the probabilities of those Democrats winning, you could therefore argue that if we do get a situation where Trump wins, that the market actually has to be a lot higher. Because
really?
Because if you think about it, if we know that the Democrats winning, let's just say on average it costs us, there's a 750 point loss. And we have a situation where, let's say, it's even up right now. That means on the other side of the equation, for it to be risk adjusted, it means it has to be a 750 point rally. Now, I don't know if I buy that. I'm going to write a blog about it because I actually think it's an interesting topic. Let's go on to the next one. What do you think of the effect of a wealth tax, capital gains tax as ordinary income, and the end of unrealized capital gains would have on the market?
Well, definitely. I mean, if you get Elizabeth Warren or something like that coming in there, that has to be a little bit scary for the markets. And so I think even just seeing which Democratic candidate is going to actually win the ticket is actually going to play in huge. I can't imagine the markets liking anything that involves taking away something that is moving the markets forward in terms of anything that's raising taxes.
Do you think it's like a Leon Cooperman style 1,000-point S&P move? Like he said something, and it was very hyperbolic about how far it was going to head it down. What do you think?
Yeah, but we heard the same thing from Mark Cuban about Trump. Like, you know what? You're always going to have
a difficult night that night when he won.
But on balance, I think that these guys come out there with these boogeyman things to try to sway the political opinion, but what they say and what actually happens are two very different things. I think that's an overshoot.
Okay, so here's what I'll tell you what I'm worried about. Although I think a wealth tax, capital gains tax as ordinary income, or the end of unrealized capital gains would hurt the market, I think what would hurt the market a lot more than that is an obsession by the Democrats to balance the budget. And I'm actually more worried about them raising taxes than I am about them doing those other things on the whole to the economy. Now, that's just me, and I think different things affect the market, but I think that one of the reasons that the market's done well is because the U.S. is running a deficit of 4.5% of GDP, and if we get a situation where they come and the Democrats think that they have to go and actually balance the budget, I think we're going to get a situation just like Germany. Germany has a surplus budget, but their economy is struggling and their stock market's stinking. So just be careful what you're asking for, because I think that is actually more of a worry than the wealth tax, capital gains tax, or the unrealized capital gains. Okay.
All right. So let me get to the next question here. So the question here for us is, what will be the tell when QE and rates are not effective?
Well, I'm already at the the opinion that QE might not already be effective. Like, what are we trying to accomplish with QE is what you have to ask yourself. And if we're trying to accomplish getting the economy going, then I think that it's never been effective. So what are the tell that QE and rates are not effective? Well, those are two different things, because rates, meaning that you could lower rates and cause the economy to pick up. there's no doubt that we've got in a situation where monetary policy in all of its forms is becoming increasingly ineffective. Right, and you could just see, even by, let's go back to Germany. I loved using the European example because the Europeans have taken things to such extreme. They've hit a point where monetary policy is not only not effective at stimulating their economy. I would argue that as they lower rates and try to put more monetary stimulus into their economy, they actually have the perverse effect of slowing their economy. So what would be the tell? That maybe it's that we all start speaking French. I'm not sure.
Listen, but let me take this a little direction. So when we were in Chicago, we were having the bull bond bear debate, and I was arguing the whole financial repression argument, and a lot of, in order for you to maintain very low interest rates, somebody has to be a buyer of bonds when governments need money. There you go. You're giving me that face. But listen, the bottom line is that, can you say it's ineffective? I mean, ultimately, yes. Let's be realistic. If they were not buyers in this market, interest rates would be much higher.
Oh my God! Really? You honestly believe that? Like, seriously, you believe that?
Well, now I'm questioning it ever since.
You honestly think the government is actually keeping interest rates limited by their bond purchases?
Well, I mean, they are buying.
Okay, so how do you explain the fact that Stanley Druckenmiller and I agree on this fact that when the government comes in and does QE in its earnest, the bond market actually backs up? Often what you'll see
because of inflation fears.
Right. Okay, so QE is not what's keeping interest rates constrained.
But
no, I'm going to take the other side of that trade, but that's a far-ranging discussion. But I would say, how do you tell when QE and rates are not effective? I think we're already there, is the truth of the matter. And the fact is that we've got a situation where we are having increasingly, the central banks are becoming increasingly impotent to fix it with lower rates. Right. And I think we're there. So now let's go on to the next question, Patrick.
All right, so do you think that the Fed will go as far as the Bank of Japan buying risk assets and to shore up the markets, or what's next?
So this is again an abomination of monetary policy, and I remember I threw up in my mouth when I heard I can't remember which guy did it. One big money manager got on CNBC or Bloomberg and started talking about that the ECB should stop buying bonds, and what they should really do is start buying the equities. And that's like, no, that is not what they need. We do not need central banks buying equities or risk assets. We need
demand. What you believe, and what they will do are two different things.
Okay.
But the question is, do I believe they will?
Will the Fed go as far as the BOJ buying risk assets? No, they will not. I do not believe that we are going to go to that kind of extreme, and here's why. I think we've already turned the corner in realizing that extreme central bank policies do not help the real economy. And that you're going to get a situation where all you do is increase wealth inequality. You're just going to send financial assets to the moon without really creating any actual underlying economic activity. I don't see it happening. I certainly hope it doesn't happen, and I'm hopeful that they're going to wake up and realize that central banks can't solve the problem. It has to be fiscal. Okay.
All right, let's move on.
So here, let's go on. Apart from shipping and uranium, do you see any commodity sectors that could be facing supply shortages over the coming years?
Yes. And actually, but it has to be even broader, which is essentially that the entire commodity complex has been in a bear market for an extended period of time. And it's not original to me. I first heard it from Rick Rule. It's that truism that, every bull market is the author of a bear market, and every bear market is the author of a bull market. And when you have an extended period where there's a massive bear market, there's supply destruction. And a great example of that was when we had a number of our guests come on and we talked, let's say, copper, and the idea that, well, listen, do you want to create a green economy that runs on electricity But how do you build the infrastructure? You need a huge amount of copper. And I remember hearing Marin Katusa say, I don't know whether this is factually true or not, but there hasn't been a
Marin
new.
said it must be true.
It must be true, but it probably it is. But we have seen that there has not been a new major copper mine put into production in like a decade. And so they're just continuously extracting this from the ground, and the prices are so depressed that they're at these levels that it's just not economical for geologists, or no, they can't, nor can they find the money to fund these projects to go and put new projects in, and eventually it's going to come to roost. And whether it's copper, whether it's all the basic materials, there's a point where this will turn, and the prices have to rise. It'll be inflationary, and you're going to win at that moment with your inflation narrative. But there will be a point where we're going to see a huge run in commodities because of what's happened, and I think it's very broad. You're going to see it in a whole array of different commodities in the markets. How about you?
Well, I agree with a lot of that. Like, what's the line? What's the best cure for low prices? Low prices. Like that's.
Yeah.
Well, it's kind of an auxiliary of Rick
Yeah.
Rule's kind of comment. I would say that I think energy will be the biggest ones that get squeezed because it's fundamental to so many parts of our economy. It's so the demand for energy is so inelastic, in that if we get a situation where we don't get the supply response that we're expecting, then it could the price movement could be huge. So I actually, even though everyone tells me that there's crude oil for miles and miles and miles, I think you're going to be surprised.
What was that stat one of our guests said? It was something like 6 barrels are being used for every one that's being discovered.
Yeah, and so I think that there's two big kind of oil fields coming on. I think there's one off Norway and then some other South American country in 2020. We're getting some still the supply is increasing, but after that, there's not a lot there coming on. And if we get a situation where the world economy starts growing, and we're not all using Elon Musk's batteries to power everyone, then we could get a situation where the demand far outstrips the supply, and there's a huge move in those commodities. Anyways, I'm in your camp, which means that we're probably going to see years of deflation in commodities.
There you go. All right, so let's move on. And so the first part of the question from one of our listeners is, what is the best way to trade the upcoming MMT?
Well, I like his style already. The upcoming. He's accepted it. I've gone over this before. I still think inflation break-evens are the absolute best way to trade it, because I think that we're going to get a situation where inflation increases, and yes, you can trade gold and other things as inflation hedges, but those again are always second derivatives of inflation. And to me, inflation kind of break-evens, meaning
how does a retail investor participate in inflation break-evens? Is there? Do you know of an ETF that does it?
It's not easy. There is one RINF, which is a listed 30-year break-even. It's not very liquid. I wouldn't recommend it. It's something to look at. I still think that a retail investor should take the time and learn how to do it, and actually figure out how to buy the tips and short the future or short the underlying, because at the end of the day, it's not going to move huge. It's not going to be something that's like a shipping stock that's going to double or triple or even quadruple in your face. It's going to be something that's just on the margin is grinding higher. But I also think at the same time, that's why it's a low risk bet and it's a better trade for me. So I would actually rather own inflation break-evens on a levered basis than a second derivative of inflation on an even basis.
Right. And so the second part of the question is, are there any books or resources that you would recommend to learn macro and options?
Well, options is easy. You should go read the Natenberg book. I can't remember the name of it. Do you know? I should go get I think it's Sheldon Natenberg. He's the kind of the godfather of it. It's Option Volatility and Pricing by Sheldon Natenberg. Just go spend the time, buy that one. In terms of on the macro side, I always recommend that people go and listen to Ray Dalio. I think Ray Dalio has a great way of explaining the fundamental kind of underpinnings of how an economy works. And I would steer them towards his site and his books. And then from there, I think that there's, I think if you actually didn't come from an environment where you've already been brainwashed with the ideas that my young friend across the table from me here, Patrick Ceresna, thinks about how the world economy works and how we're going to have deflation, I think you're actually at a huge advantage because you could get a situation where you can go read the MMT guys like Warren Mosler or Randall Ray and keep an open mind about it, and to get a situation where you're learning how a modern fiat monetary system works. And I'll repeat this again. MMT, you should divide it up into two parts. You should divide it up into the descriptive part that explains how a modern fiat monetary system works, and then the prescriptive part, which is basically the political decisions we as a society take based upon those things. And too many people get so hung up on the political decisions and all that part of it, they miss the huge kind of edges that can be occurred by understanding the descriptive part. I can't tell you, Patrick, the number of strategists, economists out there that are actually MMT consistent and just don't call themselves MMTers. And it's because they understand how it works and they understand the modern monetary system, and they are using that. Anyways, that's my lecture for today. So, Patrick, what do you specifically like about REMX, Rare Earth Metals ETF, and are you worried about the huge China exposure?
Well, you know what? I guess the big trap here is that I'm by no means an expert on rare earths.
You don't even play one on TV.
No.
But you did stay at a Holiday Inn Express last night.
but I really was just I was playing it more on the idea of the whole resource sector being so incredibly oversold, and generally I felt that as all commodities turn, that rare earths had the opportunity from such an incredibly oversold state to have lots of mean reversion where they could head higher. But as you were saying, what's your saying about rare earths?
The trouble about rare earths is that they're not so rare.
Exactly. But it certainly is concerning. The large portion of the fund that is exposed to China, but I mean generally it is actually. There's a lot of environmental issues with producing a lot of rare earths in the developed markets. You really have to, a lot of it because of the environmental restrictions have to be done in emerging markets, right?
Where they can ignore those environmental restrictions?
Well, I'm not.
Okay, so we're trying to save the world with
I'm just saying, but I'm talking about regulations. Okay. I mean, when you're trying to get the stuff produced, you can't get it by in the system in the developed market. Oh my God, unbelievable! You're like busting my balls on this. The point is, it is concerning that there is there is that much of a component.
Let's face it. You just like the chart. Let's pull up the chart. What does it look like?
It's one of those ugly from top left to bottom right kind of.
Oh, it keeps melting.
Yeah.
Well, you know what? Why did we let this question make it into the group? Actually, I put it in there on purpose. Okay, so there we go.
Okay, let's. So when looking
it's not so bad. It's actually.
So it's still very close to its all-time low, and I mean this went from $120 down to 12. Well, 90%.
It's cheap.
Down. It's
okay.
That's all we can say.
It's cheap. Let's go on to the next one, and I'm going to take this one.
All right.
Is core PCE inflation a good metric? What are its flaws? Is it oversensitive to certain categories and undersensitive to others? What do you think, Patrick?
I wasn't listening to the question when I was distracted.
Okay, I'll take it.
No, but listen.
Core PCE, it's not a good metric. Like the reality is that most inflation is terrible because it's
CPI is the worst.
Well, yeah, but what else are you going to do? The one thing I will say that's interesting is that have you ever seen this Google million prices or something? There's some crazy algorithm that the Google propeller heads made, and they basically track in real time a million prices, or probably more than a million. And it actually follows the reported inflation much better than you would have expected. especially since, everyone complains and says about the shadow stats, and if you use the old version of kind of inflation, that we would have 6% inflation and all this crap. And the hedonics, is that how I say it? Hedonics? I'm not sure how I say it, but this idea that you can take, when the price of your store line goes up, you can replace it with pork is I think it's kind of ridiculous. Not only that, like when your pork goes up and you're replacing it with some vegan crap, like that's not going to happen.
Yeah.
So the reality is that
the substitution rules you're talking about?
Yeah, I just think and then the thing that really bothers me is the idea of a car or even a computer. So you go buy yourself a new, Patrick, used to drive an old Hummer, and they don't make them anymore. So I can't use this example for Patrick, but let's just say for a regular person, they go buy a new car and it's got 20% more horsepower, and all of a sudden they say, well, it's got to be 20% better. And I'm like, well, geez, like, I don't know about you, but like, it's not getting me there 20% faster. It's not 20% more reliable. It might be a little more reliable, but on the whole, or the computer, like your iPad, it's twice as fast, so it's twice as good. Bullshit. Like, it's just crap. Like, so no doubt about it that the inflation is underreported. I 100% agree. I guess all I would say to this is that the PCE inflation is what central bankers are watching. So that's what you have to watch, and that's what you have to be sensitive to.
It's interesting. I was taking that. I was looking at all that stuff that Russell Napier and his program were when he was in Toronto, and they were doing hundreds of years of data and using the CPI, and I was asking all of the profs and Russell about inflation and CPI, and it's like, well, it's not a great measure, is it? And they say no, but it's the only thing we have that has the historical data that far back, and so a lot of the analysis that comes from it is just simply because it's been tracked for so long that it becomes the basis for all the research and work, right?
Right.
Anyway,
that the question. It's obviously we're not economists, so we don't know like the flaws of PCE versus CPI. On the whole, we just kind of feel like they're all understated, and that you should be more sensitive about what they're watching than the specifics of getting into the nitty gritty of each and every.
For sure. So let's move on, and let's take a more complicated topic of gamma. So I had two listeners write me in questions. And so both of them actually are very much on the same line. So I'll read both of them separately, but we'll answer them all as one because we're just we'll tackle this. And so the first one is, I understand delta hedging, but want to know how a market maker can be long gamma, because they have always assumed that option dealers mostly sell calls and puts to clients more so than clients sell to them. So that was the first question. The second one is, I'm just learning about option deltas. So maybe I've got this wrong, but it seems that gamma is greatest at the strike price as an option moves in the money at expiration. Since institutions are on balance premium sellers, they will do what they need to keep that from happening. Amazingly, you and others are implying that they're able to execute on the market manipulation, and that is something to be expected in normal course of things. So they're talking obviously about all of this gamma, and so I'm going to paraphrase or rephrase a lot of this. The first interpretation that many have is that the dealers are sellers, and subsequently the retail is the net buyer. But I can't think of a better person to have this conversation with than you, because rather than making assumptions, you actually were a dealer. And for years you actually did this. And so you've seen firsthand what kind of exposures you've had on the books. And so, well, let's tackle this. That's a bad assumption to make, that a dealer is always the seller, right?
For sure. Let's just start with the idea that most clients are naturally long the market, and what they're looking for is a hedge. And so what they do is they buy puts. So that reader is correct that a lot of times what clients are doing is looking to protect their portfolio, and they do that by buying puts. However, often what they do want to do is they don't want to pay too much for that, or they want to sell out of the money calls to basically harvest a yield or a premium for that. So often, like the most popular trade from a traditional money manager to hedge their portfolio is to buy an out of the money call put and to finance it by shorting an out of the money call.
Hence why for most beta 1 kind of stocks that skew exists, which
well, no, that skew exists. No, so that's the different story. The skew exists because on the whole, stocks go down faster than they go up.
Right.
So the market maker naturally demands more of a premium.
But supply and demand doesn't have to do with that?
Well, so yes, it does also have to do with. You're absolutely correct. So I shouldn't say cut you off completely. But even with even if there was no supply and demand, most market makers would price it like that.
Right.
Because the reality is that on the way down, stocks are much more volatile than on the way up. If you think about it, often we just
I'm
higher,
just thinking that
and then we,
I'm
and
just
then we
thinking
plummet
that if
lower.
everybody wants to be a covered call writer and harvesting income, and I'm always stuck with the calls on my book, I'm always going to offer lower implieds on out of the money calls.
You're absolutely right.
And
but not only that, but the actual realized of the market, the realized volatility of the market is such that on typically you get a situation where it goes down much faster than it goes up. And this is why, you'll see a situation where the skew might look more like a smile instead of a half smile on a fixed income.
Yeah.
Because the reality is that in an extreme environment, you get a situation where bonds are bid, so you actually might see the opposite skew. Or let's take gold. Gold has the opposite skew, I believe.
Or at least a nice U shape to it.
Yeah, I think gold might have the half smile the other way, meaning that the far out of the money calls on gold are much higher than the far out of the money puts, right? So now, but that is not. So we realize that that's the natural kind of typical flow, but that doesn't have to be the case. Not only that, let's kind of delve into the idea about all these clients recently that have been selling premium to collect a yield. So there's also, we've talked about the traditional clients that'll go and actually just kind of buy a put, sell a call to pay for it, and boom, there, Bob's your uncle, they let it go. There's also the clients that go out and sell straddles. You remember Option Vault? What was the guy, the natural gas guy?
Optionsellers.com.
Optionsellers.com. He basically was just harvesting premium, so he was always the seller.
Yeah.
So we get a situation in that he was most likely selling it to the dealers. Yeah, he might have been selling to the end clients, but I suspect that the dealers were just buying it. And this is, it's a difficult kind of thing to say. It's always this way. Dealers are always short, or dealers are always long. What you just need to understand is that typically that dealers are often short the out of the money puts because nobody really wants to sell those, and that they're often long the calls because again clients want to sell those. Now,
so let's talk about it from a gamma and delta.
Yeah, because let's go on to the next one because the reader or the listener is kind of implied that market manipulation is happening. And I want to just say there is no market manipulation. Clients do not go sell it out of the money put and then keep the market higher because they want it to not expire in the money. That does not happen.
Yeah.
Like, maybe on the occasional small float stock that'll happen, but the market is a big dynamic place with many, many different players. What we are talking about, though, is the idea that if, let's just say, like people ask, why do things get, if I'm correct, why do stocks get pinned at strikes?
Well,
like if there's not manipulation going on, why do stocks get pinned at strikes, right? Well, the reason that stocks get pinned at strikes is, let's just say that there's been all sorts of put buying at a certain strike, and it's trading around that strike as we get closer to expiry. What happens is the clients are selling the put to the dealer back, and then when the dealer is going, and they have to go and they have to buy they have to they're selling the put, so the dealer's long the put, and now they have to buy a stock against it. So there's a natural tendency for it to go up towards the strike. Same with when clients are selling the long call. So you get a situation where, like, if they're selling the long call, the dealer buys the call and then shorts the stock against it. So as that pressure comes towards expiry, there's a tendency for it to drift towards the strike because of the clients unwinding their positions.
Yes.
And that's the key that people need to realize, is that there's no manipulation going on. It's not like the dealers are going, let's just pin this to here. It's occurring naturally because of the flows.
And there's so many dealers. It's like in order to try to create some sort of an agreement amongst everyone to do something like that, that's like a grand conspiracy.
Yeah. Listen, are there times when a big player can affect an asset class and keep it above it for a strike? For sure. Not only that, like, think about those knock-on stock things when you get a one-touch, meaning that it pays off as soon as it gets touched at a certain level. There's no doubt that people go hunting for those, and they go, oh, let's see if we can get it up there because I can all of a sudden knock that in, right? So there's shit like that does happen, but on the whole, there's not some grand plan to kind of keep them from like holding it up so that these puts or the calls can expire.
Let's move on, and I want to just so we have a chart here from spotgamma.com.
Right.
And it's a very kind of U-shaped, very probability distribution kind of curve. But I want to specifically talk about this idea that they have what's called a high volatility zone and a low volatility zone. And if my interpretation, and you can tell me whether I'm interpreting this right, because on the right side of the chart, which has the low volatility zone, and dealers are generally long calls because they've sold a whole bunch. They are, as the delta is going up, they want to be delta neutral, and which means that they, on balance, have to be selling the market in order to stay flat.
That's correct. They are rises are causing it to be sold.
So what happens is that when you're on the right side of this curve, what's happening is volatility contracts,
right?
Because as buyers are buying, the dealers are selling, and it therefore reduces the overall volatility market.
Right.
Hence why VIX tends to actually gravitate to the bottom end of the range during rallies.
Right. And so, like, let's go back to this idea: the dealers sell the rally. So they're hedging their delta, their positive gamma, meaning that as it moves, they get longer. But not only that, as it moves down, they get shorter again. Yeah. So let's take, for example, the S&P's up to 10 today. The dealers were selling all that rally because they're long gamma right now. Tomorrow, we open down 10. Guess what they're doing? They're buying everything they sold back today.
Yeah.
And that amount, so they're sitting there trying desperately that they hope the market will move lots. But by being long, they're actually stopping the market, being long gamma, they're stopping the market from moving as much because they're dampening the effect.
Exactly. Lowering the volatility.
That's
correct. They're not changing the trend, they're dampening everything. Things just move less.
That's correct, because they're selling rallies, they're buying dips.
At the same time, the gamma flip is when dealers have all of these puts, and they're actually short the puts.
Right. So, the important thing that people realize is you could be long or short gamma through puts or calls.
Yeah.
But it doesn't really matter if it's a put or call because of put call parity. It doesn't really matter. The question is whether the dealer is long or short the option premium. So at this point, because they've sold all these out of the money puts that become in the money or are approaching in the money,
they have to sell more.
That's right, because they are no longer long gamma. They are become short gamma. So as it goes down, they become increasingly long, and they, instead of being kind of the opposite, when they were up at the above, they were selling rallies and buying dips. Okay.
Yeah.
When they're short gamma, they have to chase it. They have to sell on the way down and then they have to chase it
and
back
they
up.
exacerbate this circumstance
Exactly.
by adding selling to selling pressure. Hence why that's the high volatility zone.
Right.
And so, arguing about specific gamma levels may not be, or certain strike prices with high gamma is not as important as knowing where the flip is, because the flip creates where the high volatility. So right now on the S&P 500, the high volatility zone is, at least according to spot gamma guys, it's below 3,050. And so really any, let's say 30 or 40 or 50 point drop in the S&P doesn't mean anything. But if we have a 100-point drop and we start getting into the zone, suddenly the dealers are actually selling futures, exacerbating the selling pressure.
Right. Now, the one caveat I'll give you about all these charts, you actually don't know.
They're dynamically.
Well, no, you don't know if the dealer actually sold all those. So when I was on the desk, we would sit there, we'd make markets, but all of a sudden, let's just say someone asked me for an out-of-the-money puts. I say, okay, I'm, let's say, 12-vol bid. I'm 14-vol offer. They say, fine, bought from you. I buy, $5 million at 14-vol. I think I'm short. Then all of a sudden, I have a situation where a client comes in and says, hey, look, I'm actually looking to do a put right or whatever, and I'll sell those. And so the trade gets taken over by a client. So these things, all these charts and all of these graphs are assuming that the dealer
They
took
know
all
the
of it.
dealer exposure.
Okay? So you don't really know, because think about, let's go back to my example. If I sell that as a dealer and it goes down there, I am dynamically hedging.
Yeah.
If a Canadian pension plan sells it, they aren't dynamically hedging. Comes down there, if it finishes in the money, they'll
just take it on the position.
Yeah. So it really, and this is the one thing that people need to realize, is that the counterparty to the transaction is what makes it either more or less volatile.
Yeah.
And it has to do with the fact that dealers do not want that risk, and dealers therefore will dynamically delta hedge it. But if you have an underlying real client that takes the other side, then all of those charts are wrong.
Yeah.
So it's not quite as easy as everybody, like they make these charts out like that they're, set in stone and they know for sure that this is the case. They are very, very rough approximations of what's happening. Yeah. Just remember that, because they're not perfect by any means.
Yeah.
And so you never know if a client took another side, or if there's a over-the-counter option that we don't know exists. It was just some things to keep in mind. But I agree with you that the important thing to realize is that dealers, when they're short gamma, it means that they're chasing the market down or up. And when they're long gamma, they are doing the opposite. They are selling rallies, buying dips, and their behavior causes the market to either be more or less volatile.
Yeah, there you go.
There you go.
All right.
My
well,
opinion.
that was the Q&A, Kev.
Yeah, that's it. Our first one.
There you go. Okay, so time to wrap up the show.
Okay, this is the point where our main show ends, but those who want more Market Huddle, stick around for the after hours interview.
All right, so very quickly, some announcements. Hopefully, many of you had the opportunity to listen to this earlier, but I'm going to be out on the west coast of Canada, and I'm going to be doing the Options Education Days, Saturday, November 30th in Vancouver, Sunday, December 1st in Calgary. Tickets are still available to attend, so you go to the Montreal Exchange website to grab those. But Kevin, I can't possibly go out there without doing a Market Huddle meetup. So on Friday, at 7 p.m. I'm going to be at the Fairmont Pacific Rim Hotel Bar down there. Any one of our listeners that want to come out, no RSVP needed for the meetup. Just come out and have a beer. Just say hello and just tell us what you think and give us some questions that you want answered in the future. As well, after the Options Education Day in Calgary on the Sunday, I'm going to be at the Calgary at the Westin Hotel there in Calgary at the bar after 5 p.m. after the show ends, having some drinks. So any of our listeners that want to come and meet up and say hello there, it's on the Sunday. And so hopefully we'll get an opportunity to meet many of you. Looking forward to it.
Just a reminder that Market Huddle is available on iTunes, Android Play, Podbean, Spotify, and YouTube. To our American friends, have a great Thanksgiving. For everyone else, have a great weekend. Thanks for listening. We appreciate you taking time to join us and look forward to hopefully speaking again next week. I'm Kevin Muir.
And I'm Patrick Ceresna. Have a great weekend.
Joining us now in the after hours is Victor Adair. He's a Vancouverite, but we're not going to hold that against him. Well, let's just jump right into it, Victor. What do you think about your kind of countrymen to the east there, the Albertans, and their complaints about you guys with the pipelines?
Oh, I tell you what, I was in Calgary about 6 weeks ago, attending a conference put on by my real good friend Joseph Schachter.
And, I remember Joseph. He used to work with my father way back when in the Richardson Greenshield days.
That's right. He did work for Rich Green way back.
Yeah,
and it might have been when it was Rich before it was Rich Green. I don't know. But I tell you what, I bought a T-shirt that says, I love Canadian pipelines.
Oh, and, nice. So you're more of an Albertan than a BC guy.
Hey, listen, if Canada breaks up, and Alberta's going to go their own way, I live on Vancouver Island. This is a very NDP socialist kind of area out here. Now, it's a great place to live because it's got the best winter weather in Canada. But I'd consider moving to Alberta and going with them.
You know what? You've been in Victoria for too long, man. You might freeze in Alberta. You wouldn't be used to it.
Yeah, I know. The weather would be a problem. But then you do is you just go to Palm Springs for the winter and you'd be cool.
That's right. That's right. Actually, I'll tell you a couple of little stats that we don't want to talk too much Canada because it'll put all of our American and European listeners to sleep. But Alberta is actually got the lowest amount of representation per 100,000 people. So, I can't remember what the stats is. It's something like Canada's average is 0.9 seats per 100,000 people, meaning that's your representation in government. Alberta has a representation of 0.68. So which means they're underrepresented in the federal government. And then you combine that with the fact that they actually go and submit to the Ottawa. They are a net contributor to the Canadian fiscal situation the most. And then the real maddening part about it is we as Canadians are busy telling them that they can't even get world prices for their crude oil. We're blocking them from getting their crude oil to markets. So although I am not an Albertan, I'm very sympathetic to their cause, and I wish we as Canadians would smarten up. And we could choose what we do with the money that we earn from basically developing that energy properly. But at the end of the day, we are dumb to just be letting it kind of go to waste. We'd be better off getting world prices and putting that to green kind of climate change initiatives.
Well, I absolutely agree. We should have the opportunity to sell any of our products to more than one market. So there we go.
Yeah. Okay. So let's.
Hey, you know what? I was reading something yesterday. It was an interview by a commodity trader that there was a magazine in the 80s called Intermarket Magazine. Do you guys remember that?
No.
Oh, okay.
In the 80s, I was still listening to New Order and trying to get that.
Okay, well, Intermarket Magazine used to publish these great interviews. It was sort of like Jack Swagger's book before Jack Swagger did his books on market wizards, right?
Right.
And this was an interview with Roy Abbott, who used to be like a big individual player in the commodity markets. And I was reading that, it was reminding me of trading commodities in the 70s and the 80s. And back in those days, everybody was kind of the reason to trade commodities was to try to turn 10 grand into $1 million. You weren't trying to just kind of get 10 or 15 or 20% return a year so that you could lure a little capital away from the stocks and bonds and real estate, and advertise yourself as being non-correlated with other assets. I mean, it was sort of like everybody, whether it was Richard Dennis or on and on, these different guys, Paul Tudor Jones, everybody wanted to turn a little bit of money into a whole bunch, and the markets have changed now.
Oh yeah,
it's not as much fun. Those hedge funds have become asset gatherers instead of going for the old school shoot the lights out kind of returns.
Yeah, what did you say, that hedge funds were just beta dressed up as alpha or something like that?
Yeah, alpha just dressed up as levered beta. That's
yeah.
That's
great line.
Exactly.
I remember that from one of your sites.
And then the other problem about it is that there's nobody getting the triple-digit returns. That's what we need to return of. Apart from Crispin O'Day, who is the only guy that's ever kind of gone with size for those kind of returns. There's none of those big macro guys are willing to take trades and go up 30 or 40%. You know, I had a good friend that told me once that if you have a fund and you're up 40%, you stop trading. Because the reality is that if you're up 80%, nobody's going to give you money.
Oh, I was thinking if you're up 40%, you want to just hold it till you get through your year end so you can post a 40% year.
Yeah, no, it was more that you actually did yourself a disservice by going up 80%, that you wouldn't be able to attract money because your volatility would be too high.
Yeah, everybody thinks you're way too much of a cowboy.
Yeah, it's just that there's none. And, you know, in the good old days, Canadian hedge funds, they used to be, all those sorts of returns would be commonplace, and now nobody wants them. And everybody, as you say, is just trying to earn their, safe 8%. And that, so be it. That's fine. That's a great market. But it just seems like we've lost those truly kind of larger than life individuals that would be willing to go for that. But, maybe that's the Vancouver in blood in you, because we haven't talked about the Vancouver Stock Exchange. So now, how did you get into commodities opposed to penny stocks and gold mining promotions? Because that's usually what people from out west are, when they're in finance, that's usually their background.
Well, I tell you what, when I got out of high school, I got some summer jobs working for mining companies off in the bush. And it was perfect because you worked 12 hours a day. There was nothing to spend your money on. You could save money. My first go around out in the bush, I went and hitchhiked around Europe for 7 months with the money I'd earned in the bush, and then went back to the bush and went to university. But I was working for those mining companies, so yeah, I got trafficking in penny mining stocks, where I'd read the price that the thing was trading in yesterday's newspaper or something, because I was way out in the bush somewhere. But yeah, I started my career about 1970, 71 or something. My career as a trader. I mean, trading a few $100s worth of penny mining stocks in Vancouver. And the mining business was great for me. When we elected the first NDP government in British Columbia in 1974, NDP, for those people outside of Canada, it's more of a socialist kind of a government. I discovered the Western United States. I was all over the Western United States with about $5 in my pocket. I don't know how I stayed alive, looking at mining properties in all kinds of places down there and trying to bring deals back to Canada. Just an entrepreneur with, my last dollar in my pocket trying to do something.
Oh, okay, so you actually were in the mining business and you were doing that. And then, so when did you start trading commodities, and how long has it been that you've been this?
Yeah, there's a coda to that. I was in the mining business, but when I was in university, I had majored in creative writing and history and stuff like that. I thought I was going to be a script writer for movies when I grew up. I didn't, but I was in a mining deal in Toronto, and there was a guy on Bay Street called Sid Rosen. I remember this now. He had the entire floor in a building right on Bay Street, about 300 Block Bay. And I'm up there. We're pitching him on some mining property we got in Nevada or something. And he takes us down the hall. And here's these two guys that got hair like Jimi Hendrix. The room is blue as smoke. They got charts hung up on all the walls. There's about 30 telephones on their desk. A Reuters machine clacking away, and these guys were arbing silver between London, where they traded it in sterling, and New York, where they traded it in dollars, and they were using Sid's money to do it, and they were making a lot of money. And I just thought, what the hell is this? So that's when the hook got set.
Wow, I didn't know that. So what year was this that guys were arbing? And I would thought that there would be no way you could do that out of Toronto. Arbing between New York and London.
They were doing that. I'd say that was 1974. Wow. You remember in those times, the very first gold futures contract ever in the world was in Winnipeg. And they were trading the 400-ounce bar. And the arb there was Bank of Nova Scotia would set a price for the day. And it would be like the PM fix out of London. Well,
right.
If the Winnipeg market traded below that, people would buy Winnipeg and sell Bank of Nova Scotia because Bank of Nova Scotia kept their price the same all day long. I mean, we can't imagine. I mean, it was a layup arb. Right?
Oh my!
Yeah.
That's awesome.
You know, for a while, Winnipeg was the biggest gold trader in the world. There was like a period of 9 months or something before the COMEX listed gold, that all the Americans were trading it out of Winnipeg, and for a while it was just a hopping market.
Well, you know, during '74, the price rose from roughly $100 to $200 because the thinking was, come the first business day of January, Americans are going to be January 1975. Americans are going to be allowed to own gold for the first time since the 1930s. Okay, right. So the window opens. Americans can now come in and buy gold, and nobody shows up. So the price of gold in 1975 basically falls from $200 all the way back to $100. And then it starts this incredible run to $850 in 1981.
I didn't know the details of that story, that it was actually that they ran it up and then it was a classic buy the rumor, sell the news, and then it gave it all back. We're going to have to do that. We have a kind of a section we call This Week in Trading History. We're going to have to definitely look into that story and research that, because that's a terrific story. Like I had no idea. So that was, and that would period that the run up was when the Winnipeg Exchange was the largest trader of gold. Does that make sense?
In 1974, the gold price was going up in anticipation that this huge market of American consumers was going to go bid on the gold market, and that they'd been locked out for 40 some years. So and when they opened the window, nobody came.
Right. So this Sid Rosen guy, what did he go on to make a firm? Like, what was that firm and what was it called?
I think Sid controlled like a whole bunch of penny mining stocks on the Toronto Stock Exchange back in those days. Oh, and I think, I don't know, people are going to hear this, so I better not say too much because I'm not sure.
Sid, if you want to, you can
call in and tell us. I was in a boardroom in the middle of the building, and I saw curtains all along one wall. And I thought, there's no windows there. That can't be. We're in the middle. And so one of the guys says, oh, here. And he opened the curtains, and it was a calendar spread, like a great big flow sheet, and it listed the dates of the various companies that Sid was involved when they had their annual meetings.
Oh, okay. So he was really a stock guy that had done macro. So that was it. It set the hook, and then you were decided that macro was your true love. And did you from then on just go out and start trading futures and trading macro?
Yeah, I started to trade futures as a futures broker in British Columbia before you needed a license.
Your grandfather didn't. You actually have never been licensed.
Oh no, I have been.
No, I'm just joking.
I mean, there was a firm. I went over there. They had an ad in the paper, and I'd been trafficking in gold bullion for a couple of years. So, I got a job, commission only from day one. Sat down in front of a quote machine, and thought, okay, what do I do now? I went down to Seattle on the Greyhound bus and wrote an exam down there to pass the American exam, because I felt like I should have some sort of an exam under my belt, and I managed to pass that. But then, later, and the trouble in Canada, the commodity business was governed by the people who governed the stock business. And it's always been a problem in Canada because the stock people don't understand the commodity business. But, there wasn't enough commodity business to have like the CFTC like they have in the States. So it was like the SEC was going to look after the commodity business like a stubborn stepchild or something.
Right. To some extent in Canada, though, they also leave it alone, and they haven't updated the rules in 30 years, I think.
Well, yeah. For years, it was in the business. I mean, I struggled in that. Like commodity guys, you have a run of good luck, and then you can't find your ass with both hands and so on. But at different times, I had a lot of fellas that would report to me, like I'm managing some people. Or at one time, I was, the national manager for one of the bank-owned firms in charge of their commodities business. And I used to say to the guys, listen, I know, you're sales guys, and you hate the compliance department. They're just putting roadblocks in your way and so on and so on and so on. But let me tell you, the compliance guy is actually your best friend. because if it wasn't for him, there's going to be some other guy on the other side of the country who's going to blow up the firm, and you won't have a job tomorrow. And also, the compliance guy is going to keep you out of trouble that if you were left to yourself, you'd surely get into.
You're definitely a glass half full kind of guy.
So
no. I'm very much an optimist. Oh, absolutely.
Yeah, no, for sure. I agree. Anybody that says that finds a positive lining on the compliance guys, he has to be a kind of an optimist. I have a quick question in terms of the housing market. I got to ask you. You're out in Vancouver, you're in Victoria, I assume. So, what do you think about what's happened there and the blow up in terms of like the mad scramble into housing that we saw, and now the subsequent kind of dip, and maybe even it's getting even worse than just a slight dip. You might even call it a pseudo crash in certain parts of the market. What are you seeing there? What kind of color can you give us on the Vancouver and Victoria housing?
I would say living in Vancouver as I have for a lot of my adult life, it was the greatest trade I never made. I never had the money to kind of get started as a homeowner, and certainly wasn't willing to starve to death, to pay down a mortgage. So I wanted to have every cent that I had in my commodity trading accounts because, I had some control over that. And I just watched in amazement as the real estate market just soared and soared and soared. I also, I never wanted to take on debt. I had some real bad experiences when I was a kid where I remember going into a motorcycle shop with a buddy, and I'm looking at a motorcycle. There were Nortons, and the sales guy says to me, "Hey, you like that? You want to buy that?" I said, "Well, I kind of like it, but I haven't got enough money." What's the cost? It's $1,500. He says, "How much have you got?" And I said, "Well, I got maybe $800." He said, "Sold. You could drive out of here today with that thing." And I thought, "How do you do that?" And he said, "Financing." I said, "Oh, okay." So I got behind on my payments on the motorcycle when I was like a 21-year-old kid, and I just never liked being in debt. So when I bought my beautiful house over here in a little town on Vancouver Island, I paid cash for it.
Nice.
Fair enough. So now, do you think you must have those stories of what you saw around you? Do you think that the Vancouver market is actually topped, and are those the obscene prices that won't be seen for a long time again?
Because of the training we get in the commodities market, I think, where you see things go up and then go down, and often go down faster than they go up. I kept thinking for years that the real estate market was goofy, overvalued in Vancouver, and for years I was wrong. Okay, so that was it's a nice humbling thing, and that's a good thing to have in your personal resume. Certainly, the immigration into Vancouver was a driving factor to it. The geography, there's just not that much land. There's the ocean, there's the mountains, there's not that many places you can build stuff. So, there was that. And then, like any market, momentum begets momentum. So, yeah, do I think it's overvalued and all that? Well, now that I'm a homeowner, I hope not. but here's the thing.
Now you're skin in the game, and so you don't want to call the bear.
He's talking his position. He's talking his
position. No, I live on a little town in Vancouver Island here, and this is the best weather in Canada in the winter. So the great gray wave, as I call it, people all across Canada, as they retire, they're thinking, hey, instead of staying here in the ice and snow, why don't we go out to Victoria where you can play golf 12 months of the year? So there's going to be a bid for those properties out here. Don't you worry.
No, listen, I tend to agree. I actually love Victoria because I hate the rain. I'm a Winnipeg boy, and so for me, kind of humidity is terrible. I'm used to the cold as long as it's a dry cold. So I find the humidity terrible. And the one thing about so I hate the rain especially. So Vancouver, to me, that month in the winter when it rains every day, or even sometimes you get multiple months where it rains every day, I feel like I just kind of slip into a cold bath and slip my wrist because I couldn't be able to take it. But Victoria, on the other hand, is beautiful, and it's a microclimate because just down the road at the airport, it rains like twice as much as the actual city of Victoria.
Yeah,
it's for some reason that one little
Victoria
section
and where I live here in the Qualicum Beach area, we get about a quarter to 1/3 of the rain that Vancouver has. But you just reminded me of something there. that Saskatchewan next year, they're coming out, and on the bottom of their license plates, like, in Alberta it says Wild Rose Country, in British Columbia it says Beautiful British Columbia. In Saskatchewan, apparently, they're going to say, but it's a dry cold.
Hey, don't knock it till you've done it. Listen, you mentioned Palm Springs. People, like, that's the thing. I didn't realize that how there's humidex and things can get hotter. It can seem hotter than the actual temperature. Humidex works the other way. And when you go to Palm Springs or Palm Deserts, it might be like 100. Let's just do it in American degrees because that's how they do it. It might be 120 degrees, but the humidex is actually, it feels like 95.
I've spent lots of time. I go down for a couple of months at a time in Palm Springs. It's like Vancouver's backyard, really, and a lot of friends and clients to be down there. I love going down to Palm Springs. It's just a perfect. It's 2.5-hour flight, the same time zone, everything. I used to go all up and down the west coast of Mexico when I was younger, but now that I'm busier with my business and that, Palm Springs is just a great alternative to living in Canada.
I couldn't agree with you more.
Do we want to talk about trading more?
Yeah, I guess we'll just sure.
So actually, I wanted to talk markets, but I also wanted to just start off though asking you, like, anyone who's been trading for as long as you have, multiple decades, has obviously paid their tuition to the markets and learned through the School of Hard Knocks. What for our listeners, especially we have a lot of young listeners that love the idea of trading. What wisdom would you be willing to share with them in terms of how what they should do, what they should look out for, what you experienced? Anything you want to share with us?
I would start by saying that I am much more of a poet than I'm an engineer. That's just who I am. As I said earlier, I went to creative writing school when I was a kid. I'd say the people that I saw as retail clients over the years that most likely got into trouble were engineers and doctors.
Really?
I mean, poets, you don't want a poet building a bridge. You want an engineer to do that. But so I look at markets more like a poet would. I don't have any idea how to run a spreadsheet. I'm not interested in that. What I do know, or I should say one of my opinions, is that managing risk on your trade is way more important than what process you go through to select the trade. I mean, you got to have a process to select the trade, but once it's done, then you got to live with it. You either stay with it or you don't, and you're going to lose a lot. And that is really hard, especially when you have a bunch of trades in a row that go wrong. You think you're fooling yourself all the time that you had any idea what to do. I'd say if you can somehow learn to forgive yourself for making trades that lost money or not making trades that you think you should have. I mean, forgiveness is going to be real important. If you're a hard ass about that, you're just going to drive yourself to bad habits.
I couldn't agree with you more about that. And when you mentioned the fact that doctors and engineers are the ones that get themselves into the most trouble, I think that has to do with the fact that if you think about those two professions, they're very rarely wrong. And
right.
the consequence of them being wrong is devastating in that they will, the bridge will collapse, they'll kill the patient. So therefore, they live in an environment where they are right almost, let's hope all the time, 100%. Maybe it's 99.9999, whatever. It's a very high a level. And the problem with trading is that nobody is even close to that amount, and dealing with that uncertainty ends up being difficult for them. So I think that's I agree with your analysis that that's why they might have more trouble. And it's interesting to say, you compare yourself to a poet as opposed to as a kind of an engineer. That's an interesting way of looking at the markets.
Well, I was just an idea I had at one point in time. I think here's something I've often said. I've been in largely the retail end of the business, although I've had some huge corporations as clients too. But I've just watched, believe me, hundreds and hundreds and hundreds of people trade, and on balance lose millions and millions and millions of dollars. And I'd say, what is it that these folks have in common that I will not do? And the commonality is they will not get out of a losing trade. It's the old, well, let's give it another day or two and see if it doesn't turn around. That is the death knell. If you find yourself doing that, just stop. As I would say to my guys, it's only a trade. It's only a trade.
Yeah. I always say to the people that I train at Big Picture Trading, I always say, over your trading career, you're probably, if you're successful, you're going to end up placing tens of thousands of trades, and your success is not based on any one of them, but rather the process you use to execute all 10,000 of them. And the thing is that a lot of people that can't cut a loss are the ones that get emotionally hung up on the fact that this trade has to make them the money, and they can't let it go. And they become trapped, and they don't step back and understand it's just one of many in the process. But listen, Victor, I want to get back to some of these markets and continue conversation also, because you talked a lot about the kind of more exotic currency pairings, and you didn't touch on. I wanted to ask you a little bit more about some of these majors. Particularly, I find that the euro and the yen are, as they cross against the U.S. dollar, really they've been very compressed. There has been no meaningful trend emergent there. Do you feel that? Do you have an intuition, or do you have a trade on that you're thinking in terms of where these currencies are going next for a big move?
I don't have a trade on right now, but I saw something today that was a little bit of an aha moment. I think it was on the Market Ear website, and they were saying that the implied vol on the Euro US right now is the lowest it's been since the Euro came into existence. And I mean, you can feel it. I look at my screen here, like I'm on the West Coast. I'm up around 4 in the morning. Hit the space bar, the screens light up, and I go, look at that. Yeah, we're up or down a nickel on the euro. It's like there's nothing going on. And I remember being in a bank trading room. Gosh, it's got to be the late 80s, and like the Swiss franc was trading in around a 4% vol. And I'm talking to the guys, and everybody's mumbling about this. And like, sure as hell, like, I don't know, within a week or two, bada boom, things took off. The vol kind of gets compressed, and then away it goes. So, I'll just wait and see where it goes. Right now, I don't have a thought about which way it would go. I want to just put a little coda to something you just said about making tens of thousands of trades. I think all of the profits you're going to make from those 10,000 trades are going to come from maybe 10% of them. The other 90%, if you do everything right, are just going to kind of offset each other. Some winners, some losers. And the one thing you want to avoid is the big loser. And every once in a while, sort of despite yourself, you might stumble into a big winner, which will make the difference. But mostly it's just a game of grinding it out, remembering that it's a marathon, not a sprint, all that sort of stuff. And sizing. I mean, I trade way smaller size than I used to. Well, when I was trading as a currency analyst for Conti back in the early 80s, I mean, I would routinely trade through my margin. I'm just way over trading. But, again, in those days, we were looking to make, double, triple, 10 times your money. And, if you wanted to do that, you had to goose it. But I think the guys that stay alive, just kind of say it's only a trade. For me, like a 1% loss on a trade, okay, but it's getting to the point where I'm going to get out of it, and I'm certainly not going to hang on much longer. So sizing's real important.
So, Victor, one of the things that I always tell people that is if you have to ask what the margin is, you're trading too big.
Oh, for sure. I used to say to my brokers, do not let your clients use more than 50% of their capital for margin, because if they do, they're going to lose what they have, and they may take you down with them.
Yeah, that's good advice. So Victor, we're gonna have to, wrap it up here. Just a big thank you to be on and sharing all these kind of trading nuggets of wisdom with us. One last time, where can people find more about the services you offer and your great kind of weekly wrap up that you offer?
Yeah, the weekly wrap up, I call it my trading desk notes. It's polarfuturesgroup.com. That's a site that my son Drew and I have together. We're both licensed futures and stockbrokers here in Western Canada. if somebody wants to do business with us, they probably can. And if you're in the United States, you probably can't because of licensing, but virtually any place else in the world. And, everything on the website's free access. And we just want to wish everybody the best and have fun.
Terrific. Well, thanks a lot. It was a pleasure having you on, Victor.
Yeah, Victor, it was such a pleasure.
Thanks, guys. Cheers.
Take care. Have a great day. Okay, Lena, hop on.
Oh, wow. That was a great wrap-up.
Was
We're getting better.
Yeah.
So this beer,
It's Christmas for me.
we gotta do this.
You stopped drinking it.
I am sorry. This is going. You know what? What kind of beer is this? Because is it a specific type? Because whatever it is, I do not like it.
English brown ale, I think.
Wow,
Is that
it's just. I'm sorry. I'll just do the first one. I'm giving it a 2.1.
What?
Get out of here.
I tell you.
What?
Okay, that's me. That's it. That's what makes.
Oh
the
my
market.
God.
Go ahead, Patrick.
Okay, so first of all, I have to for the name of the beer, I give it a 10. The Jealous Mistress,
Okay,
the name is good. The first
It makes
sip,
you want to try it.
yeah, exactly. The first sip was a kick in the teeth a little bit, but actually, as the show was going on and I was drinking it, it grew on me. And I'm not saying I'm going to go and buy some, but I'm not giving it a 2.1.
Okay, so what are you giving?
I'm going to give it like a 7.
Okay, there we go. Lena.
I'm going to give it a 7.0.
I have a confession to make because I actually haven't been drinking beer
Yeah.
for the show because over the weekend we had a little birthday party for our nieces.
Oh yeah.
And my almost
You got it.
father-in-law decided to raid our fridge and drank one of the beers, and that's the beer he chose, the Jealous Mistress. He liked
What
it,
a
and he said
noble
it was
gentleman.
interesting.
He took one for the team. That's all I'm saying. He took one for the team.
He said, "Oh, this is an interesting beer." I was like, "Okay."
That's a good way of putting it.
Drinking the sponsors. The
Yeah.
sponsors send us the beers, and
So you know
Lena,
what?
You gotta lock up
Gotta
sponsor
ask
beers.
him, tell him we want a rating. If he's going to drink our beer, we got a rating. So, Lena, I wonder what you think about my picture that I put on this week's
Yeah, we
title.
gotta talk about that because
Yeah.
I think I'm half blind now. I'm not sure if that's like freckles on his back or
Oh,
if
no.
somebody
He's
had
greased,
like put
he's greased
seasonings.
himself up with Crisco and some sort of seasoning.
Stop this again.
I
But
can't
he's-
even. For
he's
those who
dressed
don't
up
know,
like a
I
bird,
got
right?
this picture that I found. It's just it's a gem, and it's a fellow that's stripped down naked, and he's a portly fellow, I would say. And I put and he's tied himself up like a turkey, and he's put an apple in his mouth, and he's got
Himself. I think someone else did it for him.
He might have, yeah.
Well, that's what
And-
I mean. Somebody obviously took this picture. So who's this other person?
That's right. And so I always
involved?
pretend these things are me, and I said the Macro Tourist is definitely not going to let Mrs. Macro Tourist come up with any more Thanksgiving role-playing games. I just think I got to give this guy, just big huge shout out, because when he does this that he just knows this is going to be all over the internet. That this is not something that's just going to quietly go into the dustbin of the of forgotten pictures and will be forever immortalized. And I think it's just awesome that this guy had the guts to do this. And I hope that if I keep putting on some weight, that I might volunteer.
Oh yeah, I call bullshit on that.
You think I'm
buddy.
already there?
No, I'm not. Oh, you're saying that if you.
Oh, if I got
Listen.
a little, because you know what, you got to be a certain it would look like a pretty scrawny bird if it was me right now. You gotta
Yeah,
be-
yeah. Like a Cornish hen.
yeah. Yeah.
But this, you know what? I just
This is
noticed
like a turducken here.
Yeah. What were you saying, Lena? Go ahead.
I just noticed like a big clear plastic, like a tabletop, I guess, like a table cover.
Yeah.
And I guess they were expecting things to get messy, and I'm thinking, is this like a prequel to
No.
the movie Seven? It just seems kind of creepy now.
Oh my God.
After
Lena, you're
noticing
ruining it for
that.
us, Lena. Look, good job, Lena. This is good fun, and you're making it sound like what's in the box.
That's
Do you think they cut this guy's head off and put what's in the box?
well, more importantly, did they make stuffing?
There you go.
No, that is.
right, okay. We're changing the topic. Lena, you're going down to Atlanta for Thanksgiving, are you not?
Yes, I am.
Oh, so you're going to enjoy a proper... You're not going to stay in Canada. You're going right down to do a proper American Thanksgiving, right?
That's right. We're just going to be missing a whole deep fried turkey.
Not in
But,
Atlanta, you won't. They're
My
going to
parents
be
don't
deep
like
frying
turkey.
turkey. They'll be turfurkin or whatever it is.
Turducken.
Turducken. Oh,
Yeah.
what is it? Okay, so what? You take the duck and you put it in the turkey.
Yeah, I
and
think you
sh-
put a Cornish hen into a duck
No,
and
it's
a duck
it's
into...
a chicken wrapped in a
chicken.
duck wrapped in a turkey.
There you go.
You need the duck because you need the extra fat. Because
Yeah,
duck
okay.
is a
And
fattier.
some people also wrap the whole thing in bacon.
In
also.
bacon.
What?
Nice.
Yeah, I've had that before.
And then deep fry it.
Oh, I don't know if the one that I had with bacon wasn't deep fried, but it was delicious.
What?
Oh,
So
wow.
listen, a big reminder to our American friends that when you're deep frying your turkey, be very careful because like every year, lots of people are scalded, and they like go it under
My
their...
brother-in-law is like totally into that. We had a great because we in Canada we have our Thanksgiving like a month earlier.
Yeah.
And he's into that. But we
Did you-
basically do it in the middle of his lawn.
Yeah.
Yeah, you don't mess around and do it indoors.
No,
And
no.
you can't
But
just
even
use
then,
any oil either.
it's like it can be a disaster.
Yeah, you got to make sure the turkey's dry. All ice, all water has to be removed, and you have to do it slowly, dipping it into the deep fryer. Because like you just drop it in, the thing just like.
yeah.
But it was crazy. But you know what's the worst? It's like I was all nice and dressed up, and I'm helping him do this, and the steam is greasy from all the thing, and it's like you feel gross, and it gets on your clothes and shit. It's actually not cool. Like you honestly need to bring a change of clothes when you're deep frying a turkey. Like
Maybe that's what happened to this dude on the picture.
So Kev, you have a different tradition on U.S. Thanksgiving, right? Like
One of my good buddies, he has everyone at his shop, and we drink lots of beer and watch football. Lots of beer.
It's
a big
almost like being American in Canada.
Well, yeah, we just shut down. The market shuts down. Nobody in Bay Street's there. Like
Yeah.
everyone's at the bar. It's probably one of the busiest bar times around. And at least every trader, like I don't like
Yeah.
phone a Bay Street trader desk at that 1 o'clock. No, nobody's gonna be answering.
It's like a half day at work.
Yeah, it is like a
Those
half
people.
day. You might as well. So get up, you do a couple trades, and then you go to the bar. Basically, it's just you gotta go to work so your wife thinks you're actually working, and then that's the key to this whole.
I gotta find a new tradition to do. Like I've just never got like you gotta. I love the fact that you just do that every year. That's awesome. Like I feel left out. Like I should do
I
something.
feel like I should get you an invite. You can come.
Oh, well, not this
Jim,
year,
if you're
but
listening, Jim, you gotta invite Patrick. He's lonely.
there you go.
You can go have your jealous mistress instead.
Oh yeah,
my
no, I'm
God.
bringing a case of jealous mistress for everybody.
Jeez, lucky them.
All right.
Okay, well, Lena, we'll let you go because you got a lot of editing to do. You're a real trooper for doing it because I know that you're gonna off to Hotlanta.
That's right.
Hotlanta.
To Hotlanta.
That's what it's
That's a
called.
great name.
Yeah, it is a good name. Good place. Go to the Coke Museum.
Oh, I've been there already. More
What
than
else? There's two things there. What's the Coke Museum, and there's the second one right beside it.
The aquarium.
Oh yeah, we were talking about that.
Yeah.
The aquarium's actually pretty cool. Oh, so
Yeah, it's really cool.
we basically wherever we are, Patrick, we go. It's our family. We go to the aquarium, and the Atlanta Aquarium, I think, has one of the biggest tanks in the world. And oh, there it is, Lena. It's a whale shark. And
Oh yeah.
They
yeah,
have
yeah.
these. So it's the Georgia Aquarium is an exhibit that is unfathomably large, the size of a football field, ranging from 20 feet to 30 feet deep, and is filled with 6.3 million gallons of seawater.
Wow.
Not only that, it's filled with 4 amazing whale sharks, which are those big, huge guys. Like, the ones that are like 25 feet long? It's crazy. It's crazy.
25 feet?
Yeah, they're like, they might even be bigger. I'm not even sure.
I think you're gonna be bigger. 25 feet's not that big.
Well, let me just
Not for a
have
whale
look.
anyway. Like 25 feet is long for an alligator, but not for a whale.
No, it's not a whale. It's a whale shark.
shark.
It's a shark, technically.
Oh, is it?
Patrick's like, he's
I'm
lost.
so bad at this shit.
He just
Holy
like,
shit.
he wants to go like hunting alligators or whatever.
Oh my god.
No,
yeah.
he's gonna go eat squirrels in the woods.
Oh
Yeah,
my
that's
god.
right. Eating squirrels. in the
But
woods.
we're gonna end this conversation right
Lena,
here.
I love it how you bring that right back to the squirrels. We're never gonna let him forget that.
That's right.
Yeah.
They were delicious. They were delicious.
Yeah, there we go. Viewers never
You
let
have your
Pat-
squirrels and your jelly.
Hey, you know what? They were
woods.
wrapped in bacon. You screw wrapping a turkey in bacon.
the. Okay, they're 5.
All right.
They're 5. 1 second. Let's do this. 5.5 meters to 10 meters. So let's just meters in 5.5 meters. They're See, I was right. They're 18 to 40 feet.
Wow.
It's probably 25 feet. They're probably not the biggest ones. Anyways.
Have a great weekend, everyone.
Yeah.
Safe flight for you, Lena.
Yep.
And
Thank you.
and we will resume this conversation next week with a very normal episode.
Yeah. The only thing we'll make sure Patrick never forgets that he ate squirrel once. Happy Thanksgiving to all our
All right.
U.S. listeners. Take care, guys. Bye-bye.
Happy Thanksgiving, everyone. Cheers.